let me kick this off with a, this looks like Q2 looks like a stabilization and growth forward sort of a quarter for Chola. I wanted to get your sense about a comment that the company had made earlier, where you had said that the growth guidance on AUM would be cut from 23-25% to close to about 20-22%. In the current quarter, it's about 21% odd on the AUM side. Just trying to gauge whether you're sticking to the cut guidance, or do you think that there's more sort of gas available to sort of hit that 25% number?
Actually, currently we feel it should move further up to somewhere in the 22 to 23 range, considering the GST reduction impact that has come through, and we are seeing the traction already, in the first month of this Q3 post the festivals. So we should hold on and maybe look at some improvements as we move forward.
Okay, hold on and some improvement going forward. Just trying to get from your business, from the kind of lending that you do, which sector specifically do you think will benefit from this GST cut and the rapid rate cuts that we've seen from the Reserve Bank?
So primarily it will be the vehicle finance and the consumer durable. These two will immediately see the benefits that will come through, especially the segment of borrowers in vehicle finance which we handle, because for them they don't avail the GST credit, and so for them the benefit is immediately visible and it directly flows to them, and their EMI burden will also come down as the cost of the vehicle is lower. So we see that benefit passing through to the customers of vehicle finance first. Consumer durables, we are already seeing traction in the festival demand picking up, and we will see some good numbers in the Q3 when we come out with the total festival demand impact coming through in Q3. Gold has improved, the value of gold improved, so there has been good traction in gold. Though it's a very small or insignificant number right now from the overall portfolio perspective, but that has got traction to work on.
Okay. I want to pick a question around the asset quality scenario. There you've seen your stage 3 assets actually rise. Even the gross NPA figure, according to the RBI's calculation, that also has gone up. Coming to your guidance side of the story, earlier you had estimated about 1.5 to 1.6% elevated credit costs. During the rest of the half of the financial year, as the book grows further, what is your expectation looking like?
Yeah, we had already said that in Q2 this will more or less be similar to Q1, and that's what we have experienced right now. And we will, well, it has been a marginal improvement compared to the Q1. Q2, Q3, Q4 would be better quarters because the earning potential of the customers are better in these quarters, considering they will get better load on their vehicles, as well as in the other segments also they will have better earning capacity. This segment earns and pays, so for them, it is not like they have deep pockets to rely on. So when there is good economic traction, then they earn and pay, and so the servicing improves in these quarters. Always Q3, Q4 are better quarters, so we rely on them. The only catch that could be is the continuing months